All right, let's dive into this explainer, and we need to start by grounding ourselves in a pretty massive shift from what we've covered so far. If you've been with us through Cycle 01 on revenue and collections and Cycle 02 on procure to pay, you know that in those areas, the transaction itself drove the entire process. But now, in Cycle 03, we are entering a totally different paradigm. Here, it's the human's legal classification that drives absolutely everything. The system you use, the documents you collect, the taxes you withhold, and the massive liability exposure hanging over you if anything goes wrong, it all stems directly from how you classify the person doing the work.
So here is our roadmap for today's briefing. We'll start with the new layer of complexity we're facing, look at the two separate workforce tracks, run the gauntlet of the three classification tests, break down the limits of Section 530 relief, and finally, look ahead to our pre-engagement setup. Okay, Part 1, a new layer of complexity. This cycle covers the complete cost lifecycle for absolutely everyone performing work for a business. And because we are dealing with human capital, the stakes are incredibly high. Getting this wrong doesn't just mean a slap on the wrist. Misclassification creates severe, retroactive financial exposure. I really want you to burn this golden rule into your mind. The worker classification decision is not a preference. It is a legal determination. You cannot just choose to call someone a contractor because it's cheaper or because it's easier. We have to completely shift our risk paradigm away from seeing this as a cost management choice. It's a strict legal standard. Full stop. Moving right along to Part 2, the two separate tracks. Think of your workforce as existing in two entirely separate parallel universes, and we have to deeply understand both regardless of what a client's current workforce looks like. On the employee track, everything runs through payroll. You absolutely need a W-4 before their first paycheck, you're withholding taxes, providing benefits, following FLSA overtime rules, managing workers' comp, and issuing a W-2 at year-end. But then, on the independent contractor track, it's a totally different operational reality. They are paid through accounts payable. You need a W-9 upfront. There is zero tax withholding, no benefits, no FLSA rules, and generally no workers' comp. Mixing these two tracks up, even by genuine mistake, is exactly how companies detonate massive legal and tax landmines. Now here's a magic number to keep in your back pocket: $600. For anyone on that independent contractor track, this is the statutory threshold. If a contractor is paid $600 or more during the calendar year, you are legally required to issue them a Form 1099 NEC. It's a hard and fast rule. No exceptions. So, let's play out a scenario. What happens if a company decides, hey, let's just classify this worker as a contractor to save on payroll taxes, or maybe the worker even asked to be a contractor to get a higher hourly rate? Well, let's say 3 years down the line, an auditor comes knocking. They look under the hood and uncover that convenience-based decision. The result? A catastrophic wave of retroactive penalties, stretching all the way back to day one. Which brings us to Part 3, 3 tests of classification. Welcome to the gauntlet of legal tests used to actually determine if someone is a contractor. And listen, this is crucial. Passing one test does absolutely not mean you pass all 3. Someone could be fully compliant under federal tax law, but still be deemed an employee under state law. The first hurdle is the IRS Common Law Test. The IRS looks at 11 different factors, grouped into 3 main buckets. First, behavioral control. Basically, does the company control exactly how the worker does the job? Second, financial control. Does the worker invest in their own tools, and can they actually realize a true profit or loss? And third, type of relationship. Are they receiving benefits, and is it a permanent gig? Basically, the more control the employer exercises, the more likely the IRS will say, nope, that's an employee. And if the IRS determines you got this wrong, they are not going to be gentle. You are looking at back FICA taxes. And actually, scratch that, it's not just back taxes. It's both the employer and the employee's share of those FICA taxes, plus back FUTA and state unemployment insurance, plus compounding penalties and interest, and, maybe most terrifyingly, potential exposure for back benefits. Imagine having to retroactively fund 401k matches and health insurance for the last 3 years. Okay, next up is the Department of Labor's test. They use the Economic Reality Test, specifically for the Fair Labor Standards Act, or FLSA. They evaluate 6 factors, but it all really boils down to one core question. Is the worker economically dependent on the company, or are they genuinely out there operating an independent business? The DOL is going to focus heavily on the worker's opportunity for profit or loss. And here is where the DOL really shows its teeth. If you misclassify a worker under the FLSA, you don't just owe them back pay for unpaid overtime and minimum wage.
The DOL slaps on liquidated damages equal to 100% of those back wages. So whatever you retroactively owe them, you have to pay it double.
Finally, we have the strictest test of them all, the ABC test. This is the law of the land in states like California, New Jersey, Massachusetts, and Illinois. It's a strict three-part test, and all three parts must absolutely be satisfied. Part A, they must be free from control and direction. Part B, the work must be performed outside the usual course of the company's business. And Part C, they must be customarily engaged in an independently established trade. Fail even one and they're an employee. Let's put this into practice with a real-world example. Can a software developer be an independent contractor for a software company under the ABC test? Well, think about it. They fundamentally fail Part B. Even if they have total freedom and control, the work they are doing is literally the core business of that software company. So regardless of their intent or what fancy contract they signed, they are legally an employee. In a state like California, getting this wrong triggers massive penalties and sets you up for a devastating class action lawsuit.
When you look at these compounding consequences laid out side by side across the IRS, the DOL, and state ABC tests, it's pretty staggering. You could theoretically pass the IRS test and dodge federal tax liability, but completely fail the ABC test and get hit with a state-level class action. It's like navigating a legal minefield. This is exactly why classification requires absolute precision.
Let's move to Part 4, Section 530, Relief Limits. Now, sometimes you'll hear folks talk about IRS Section 530 as a sort of emergency ripcord or a get-out-of-jail-free card. We need to be crystal clear about what it actually does. It provides limited relief from federal employment tax liability, but only if you meet three very strict conditions. You must have a reasonable basis for treating them as contractors, you must have treated all similar workers consistently, and, this is the big one, you absolutely must have filed your 1099 NECs. No 1099s filed, zero relief. But here's the catch, and it's a huge one. Section 530 will not save you from everything. It does not protect against state tax liability, it does not protect against a DOL overtime lawsuit, and it definitely doesn't protect against benefits claims. It is a last resort defense for federal taxes, not some strategic planning tool you can just rely on. And finally, Part 5, moving to pre-engagement setup. Knowing everything we know now, the rule going forward is remarkably simple. Every single classification decision must be supported by documented facts before anyone lifts a finger to work. Decisions made out of convenience create massive retroactive exposure. So I'll leave you with this final thought. Is every engagement in your workforce built on a documented legal determination or a costly assumption? Because as we've seen today, those assumptions will absolutely catch up with you. That wraps up our conceptual framework for today. In our next explainer, we're going to take all this theory and move into the practical first steps, building the mandatory compliance infrastructure you need before you hire your first employee or contractor. We'll see you there.